Think back to school. How many hours did you spend grappling with quadratic equations, memorizing historical dates, or dissecting Shakespeare? Now, honestly, how many hours were dedicated to understanding how money actually works? For most of us, that number is a resounding zero. It's wild, isn't it? We're taught complex formulas we'll rarely use, yet the simple, foundational principles of building wealth are left out entirely, almost as if by design. This isn't an accident, it's the quiet truth behind why financial understanding often feels so out of reach. The absence of financial education isn't just a curriculum gap, it's a societal one. While we excel at teaching subjects that prepare us for jobs, we often neglect the knowledge that empowers us to build a better life, financially speaking. It creates this silent curriculum where lessons about money are either absorbed through trial and error, or, more often, simply not learned at all. The principles that make someone wealthy aren't complex, they're straightforward. But they're not obvious, and they're certainly not taught in school. And that's the core of the problem we're unpacking today. Let's start with a concept so powerful, it's often attributed to Albert Einstein as the eighth wonder of the world: compound interest. It's simple, really. It's earning returns not just on your initial investment, but also on the accumulated interest from previous periods. Think of a snowball rolling down a hill. It picks up more snow, getting bigger and faster. The earlier you start, the more dramatically this effect multiplies over time. This isn't rocket science, but it is the bedrock of long-term wealth creation, and shockingly, it's not something routinely explained in high school economics. Figures like William Ackman didn't get where they are by discovering a secret formula. They simply understood and leveraged these fundamental principles, often starting young. The early bird genuinely gets the worm in investing, because compounding needs time to work its magic. Delaying even a few years can have a devastating impact on your ultimate financial outcome. It's not about having more money to start, but about starting sooner, letting that snowball gather momentum. This isn't about exclusive access, it's about basic financial physics that anyone can apply. Let's put some numbers to this. Imagine two friends, both investing just $200 a month at an average 8% annual return. One starts at 25, the other at 35. By age 65, the one who started at 25 would have accumulated well over $700,000. The friend who waited just 10 years? They'd have roughly $300,000. That's a difference of over $400,000, simply for waiting a decade. This isn't about market timing, it's about the pure, mathematical power of time and compounding. This knowledge alone could shift the financial trajectory for millions, yet it remains untaught. Another fundamental that's often misunderstood is risk. For most, risk simply means losing money. But for the financially savvy, risk is a calculated exposure, an integral part of generating returns. It's about understanding the probability of an outcome and weighing that against the potential upside. It's not about avoiding risk entirely, which often leads to avoiding growth, but about managing it, diversifying it, and understanding which risks are worth taking for a desired reward. This nuanced perspective is completely absent from our general education, leaving many paralyzed by fear of loss. This difference in perception creates a massive divide. The average person tends to see risk as a negative to be avoided at all costs, often leading to passive strategies like leaving money in low-interest savings accounts. In contrast, those who understand finance view risk as a spectrum, an opportunity to be strategically embraced and managed. They understand that taking no risk is, in itself, a risk, the risk of inflation eroding your purchasing power over time. It's about being proactive versus reactive, a fundamental mindset shift that separates the financially empowered from the rest. Then there's the principle of value investing, popularized by legends like Benjamin Graham and Warren Buffett. At its core, it's incredibly simple: buy something for less than its intrinsic worth. It requires patience, research, and the discipline to go against the herd. While the market might fluctuate based on headlines and emotions, a true value investor focuses on the underlying business, its assets, its earnings power. This isn't about guessing future stock prices, it's about understanding what you own and acquiring it at a discount. Again, simple, yet rarely explored in our formal education. William Ackman and his firm, Pershing Square, have frequently exemplified this philosophy. Whether it's taking a significant stake in a restaurant chain like Chipotle or a company like Lowe's, their investment thesis often boils down to a deep dive into intrinsic value. They look for businesses they believe are temporarily undervalued by the market but possess strong fundamentals and growth potential. This isn't about chasing fads, it's about rigorous analysis and conviction, holding strong against short-term market sentiment. It's a testament to how simple principles, deeply understood and consistently applied, can yield extraordinary results. Why aren't these simple principles widely taught? Part of it is cultural. Financial habits, good or bad, are often passed down like an inheritance, often implicitly. If your parents struggled with debt or never discussed investing, it's likely you won't magically acquire that knowledge. This quiet inheritance of financial ignorance perpetuates cycles, making the wealth gap even wider. It's not about blame, it's about recognizing the systemic impact of a lack of formal education in these critical areas. We can't expect people to know what they've never been taught, and what they haven't seen modeled. The numbers paint a stark picture. A significant percentage of adults worldwide struggle with basic financial concepts. Studies show that roughly 4 in 10 Americans can't answer more than 3 of 5 basic financial literacy questions correctly. Even more concerning, a much smaller percentage truly grasp the concept of compound interest. This isn't just an academic exercise, it translates directly into real-world consequences: poor debt management, insufficient retirement savings, and missed opportunities for wealth creation. The gap isn't just in knowledge, it's in potential. So, why aren't schools teaching this? There are many theories: a crowded curriculum, lack of trained teachers, or perhaps even an unspoken benefit for existing power structures to maintain a degree of financial ignorance among the masses. Whatever the reason, the outcome is the same: generations enter adulthood unprepared for the financial realities they'll face. They graduate with diplomas, but without the toolkit to navigate loans, investments, taxes, and inflation. This missing chapter isn't just an oversight, it's a profound systemic failure that impacts everyone. Let's talk about debt, another area riddled with misconceptions. For many, debt is a dirty word, a trap to be avoided at all costs. And yes, consumer debt, like high-interest credit cards, can absolutely be destructive. But debt itself is merely a tool. Strategic investors and businesses, like those William Ackman invests in, understand that good debt used to acquire appreciating assets, fund education, or grow a business, can be a powerful lever for wealth creation. The distinction between good debt and bad debt is critical, yet rarely emphasized in a way that empowers individuals. This difference in understanding leads to vastly different outcomes. The average consumer often falls into the trap of high-interest consumer debt for depreciating assets, like buying the latest gadget on credit. They're paying others interest. In stark contrast, strategic investors use low-interest debt to acquire assets that appreciate or generate income, making the debt work for them. This isn't about being debt-free, it's about being strategically indebted. This fundamental distinction is a game-changer, and it's a secret weapon for those who understand it. Another contributing factor to the wealth gap is information asymmetry. The wealthy often have access to better financial advisors, exclusive investment opportunities, and robust networks. This isn't necessarily about malice, it's simply how systems often work. The information that could benefit everyone, especially basic financial education, isn't disseminated widely or effectively. Without a baseline understanding, it's impossible for most people to even know what questions to ask, let alone where to find reliable answers. This creates a cycle where the informed get richer, and the uninformed struggle. Beyond the technical principles, there's behavioral finance, the study of how psychology influences financial decisions. Emotions like fear and greed often sabotage even the best-laid financial plans. Panicking during a market downturn, chasing hot stocks, or procrastinating on budgeting are all emotional responses that cost us dearly. The wealthy, or those who simply understand these principles, learn to detach emotion from their financial decisions, relying instead on logic and discipline. This mental game is perhaps the hardest to master, yet it's crucial for sustained financial success. William Ackman has faced highly emotional, public battles, like his famous short position against Herbalife. Regardless of your stance on that particular investment, what's evident is the discipline required to maintain a conviction in the face of immense public pressure and market fluctuations. He exemplified holding firm to a thesis based on research, not succumbing to the immediate emotional tide. This ability to separate feeling from fact, to trust one's analysis even when it's unpopular, is a hallmark of truly astute investors. It's a powerful lesson in behavioral finance, applied in real time. The cumulative cost of financial ignorance is staggering. Studies suggest that the average American household loses thousands of dollars each year due to avoidable fees, poor interest rates on loans, and missed investment opportunities. Over a lifetime, this can amount to hundreds of thousands, or even millions, in lost wealth. It's not just about what you earn, it's about what you keep, and what your money does for you. This ignorance tax is quietly levied on those who weren't taught the simple rules, widening the gap between those who know and those who don't. So, what's the solution? It starts with you. If schools aren't teaching these vital lessons, it's up to us to seek them out. The good news is, in the digital age, financial education is more accessible than ever. There are countless books, podcasts, online courses, and reputable channels breaking down these concepts. You don't need a finance degree, you just need curiosity and a willingness to learn. Break the cycle of inherited financial ignorance. Equip yourself with the knowledge that actually makes a difference, the knowledge that genuinely makes you rich, not just in money, but in understanding and freedom. In the end, the most powerful financial principles are surprisingly simple. Start investing early and consistently, understand and manage risk, buy value, use debt strategically, and master your own financial psychology. These aren't secrets reserved for the privileged few, they are accessible truths that, once understood, can fundamentally transform your financial life. It's time to demand better financial education, for ourselves and for future generations. Because knowing how money actually works isn't just about getting rich, it's about gaining agency, security, and true financial freedom. Thanks for watching.